Profit and loss statement. Profit and loss statement is a cornerstone of financial reporting that provides insights into a company's revenue, expenses, and profitability. This topic delves into the intricacies of the profit and loss statement, uncovering its components, significance, and analytical applications. Whether you're an investor, business leader, or aspiring financial analyst, understanding the profit and loss statement is essential for evaluating a company's financial performance and making informed decisions. The profit and loss statement, also known as the income statement, is a key financial statement that summarizes a company's revenues, expenses, gains, and losses over a specific period. It provides a comprehensive view of the company's financial performance, highlighting its ability to generate profits and manage costs effectively. Components of the profit and loss statement. 1. Revenue. Revenue represents the total income earned by the company from its primary business activities, such as sales of goods or services. It is the top line of the income statement and serves as the starting point for calculating profitability. 2. Cost of goods sold. COGS. COGS includes the direct costs associated with producing or acquiring the goods sold by the company. It encompasses expenses such as raw materials, labor, and manufacturing overhead directly attributable to production. 3. Gross profit. Gross profit is calculated by subtracting COGS from total revenue and represents the profit generated from core business operations before deducting operating expenses. It reflects the company's ability to generate revenue while controlling production costs. 4. Operating expenses. Operating expenses consist of costs incurred in running the day-to-day operations of the business, excluding COGS. These expenses include salaries, rent, utilities, marketing, and administrative expenses necessary to sustain business activities. 5. Operating income. Operating income, also known as operating profit, is derived by subtracting operating expenses from gross profit. It measures the profitability of the company's core business operations before considering interest and taxes. 6. Non-operating items. Non-operating items include gains or losses from activities outside the company's primary business operations, such as investment income, interest expenses, and extraordinary items. These items are typically reported separately to provide clarity on the company's overall financial performance. 7. Net income. Net income, also referred to as the bottom line, is the final profit figure derived after subtracting all expenses, including operating expenses, non-operating items, interest, taxes, and extraordinary items, from total revenue. It represents the company's overall profitability for the period. Significance and importance. 1. Performance evaluation. The profit and loss statement is a vital tool for evaluating a company's financial performance and profitability. It provides stakeholders with a clear understanding of the company's revenue-generating capabilities and cost management efficiency. 2. Decision-making. Business leaders use the profit and loss statement to make informed decisions about resource allocation, pricing strategies, and business expansion opportunities. It helps identify areas of strength and weakness within the business and guides strategic planning initiatives. 3. Investor analysis. Investors rely on the profit and loss statement to assess the company's financial health, growth potential, and investment attractiveness. It provides insights into the company's revenue trends, profit margins, and overall business sustainability. 4. Creditworthiness evaluation. Lenders and creditors analyze the profit and loss statement to evaluate the company's ability to generate sufficient profits to cover its debts and obligations. It helps assess the company's creditworthiness and repayment capacity. 5. Financial transparency. Transparent reporting of financial results through the profit and loss statement fosters trust and confidence among stakeholders, including shareholders, employees, customers, and regulators. It demonstrates the company's commitment to accountability and integrity in its financial reporting practices. Analytical tools and techniques. 1. Profitability ratios. Profitability ratios, such as gross profit margin, operating profit margin, and net profit margin, are derived from the profit and loss statement to assess the company's profitability relative to its revenue and expenses. 2. Trend analysis. Comparing the profit and loss statement over multiple periods enables trend analysis, highlighting patterns, fluctuations, and changes in revenue, expenses, and profitability metrics. It helps stakeholders identify emerging trends and evaluate the company's financial trajectory. Conclusion. In conclusion, the profit and loss statement is a fundamental financial statement that provides stakeholders with valuable insights into a company's revenue, expenses, and profitability. By understanding its components, significance, and analytical applications, stakeholders can make informed decisions, assess financial performance, and drive business success. Whether you're a seasoned investor or a budding entrepreneur, mastering the profit and loss statement is essential for navigating the complexities of the business world and achieving sustainable growth. Useful expressions. Revenue reflects income, while expenses show costs incurred in the profit and loss statement. Operating expenses include day-to-day costs, impacting profitability in the profit and loss statement. Analyzing trends in the profit and loss statement aids in performance evaluation and decision-making. Investors assess profitability ratios derived from the profit and loss statement for investment decisions. Transparent reporting on the profit and loss statement fosters trust and confidence among stakeholders. Non-operating items on the profit and loss statement include gains or losses from external activities. The profit and loss statement is vital for evaluating a company's financial performance and health. Understanding revenue and expenses on the profit and loss statement aids in financial management. Net income indicates the company's profitability after deducting all expenses on the profit and loss statement. The profit and loss statement provides insights into a company's revenue-generating capabilities. Analyzing operating expenses helps identify areas for cost reduction on the profit and loss statement. Investors use the profit and loss statement to assess a company's growth potential and sustainability. Transparent reporting of financial results builds credibility and investor confidence in the profit and loss statement. Comparing profit margins over time reveals changes in the company's financial performance. The profit and loss statement guides strategic planning and resource allocation decisions for the company. Revenue, expenses, and net income are key elements analyzed in the profit and loss statement for financial assessment. Understanding profit margins aids in evaluating company performance on the profit and loss statement. Net income indicates overall profitability after deducting all expenses on the profit and loss statement. Operating expenses impact profitability, making cost management crucial on the profit and loss statement. Investors assess profitability ratios derived from the profit and loss statement for investment decisions.